are in the aftermath of the June FOMC meeting, with interest rates around the globe at new lows and U.S. Treasury yields, such as the 2-year Treasury note yield, back to their lowest level in the last 12 months. The question is, what's happened? What's changed? What's our view? We think there are two possible explanations for what's driving markets right now. The first is that the weak non-farm payroll employment report out of the U.S. in May, a report that showed there were 38,000 jobs created during the month, has sent a harbinger, a signal to the marketplace that the economy is on weaker footing than previously thought, and that's being reflected in interest rates. Now, if that's what's driving the market, we would have a couple of things to say in response. First of all, you shouldn't put too much emphasis on the 38,000 number. The obsessive focus in the media and in the markets on that number masks a very complex labor market situation. We prefer to look at non-farm payroll employment by looking at aggregate employment year on year, percentage change. And if you do that, it's been growing at about 2% for the last 4 years. The May report changes that story very little. We would also point you to two other factors in the labor market story. Number one, layoffs are extremely low. We've seen 67 consecutive weeks where layoffs have been below the 300,000 level. We haven't seen a stretch of such low layoffs since the early 1970s. The other aspect of the labor market is the fact that job openings are at record highs. We've got 5.5 million unfilled job openings. So just to summarize, we have employers looking to fill more jobs than ever before, and we've got fewer layoffs than we have had in 40 years. To us, our interpretation is that's a sign of a pretty solid labor market and not one that's on a weakening trend. Now, that brings us to the second explanation for interest rates and interest rate developments in recent weeks and months. There is a thirst on a global basis for yield. We have negative interest rates in Japan. We have the European Central Bank in the last week commencing a corporate bond buying program. And it's putting clients, investors in a situation where they need to look globally for yield. Perhaps one place they are looking is the U.S. Markets, treasury bonds, investment grade corporates, high yield corporates, and that's depressing the levels of yield. Now, if the latter story is what's driving yields, we think, well, the thirst for yield is a structural issue. There is a shortage of assets for investors to buy, and that's going to be with us for quite some time. But if the real driver or one of the dominant drivers is the weakness, the sort of anticipated weakness in the U.S. economy, we think that's the wrong interpretation of the data. And I think that brings us to the major point here. The Fed often talks about being data dependent. Well, data dependence is a myth. All data is subject to interpretation, and I think our highest conviction view is that if the market is interpreting the data to mean that a recession is imminent, the market is probably too confident in that view and is probably going to be wrong. Our interpretation is that the labor market is fine, it is healthy, and we'll see that as the data emerges over the coming months. Thank you.